Welcome to Dividend and Conquer, where we dissect the mysteries of the dividend world. Today, we dive deep into SCHD, an ETF that has consistently outperformed many, but does it have the stamina to continue its winning streak? For the past decade, SCHD has been the talk of the town, delivering an impressive annual return of 13.5%. With a dividend yield standing tall at 3.29%, it's evident why this ETF is a favorite for many. To put this in perspective, the S&P 500 took a hit of 14% during the same period, whereas SCHD only dipped by 4%. Clearly, SCHD is seen as a powerhouse in the dividend ETF arena. But what exactly sets SCHD apart? Firstly, SCHD's underlying strategy targets companies that are both financially healthy and have a solid track record of paying dividends. This formula ensures that the ETF isn't merely chasing high yields, which can often lead to undue risk, but is instead placing emphasis on stability and sustainability. It's this blend of reliability and robust dividend yield that has kept SCHD in the limelight. One might wonder what's the magic behind SCHD's resilience, especially when markets are turbulent. Part of the answer lies in its diversification across sectors. It doesn't concentrate heavily on one industry, which can be susceptible to sector-specific downturns. This holistic approach allows it to weather storms more effectively than some of its counterparts. Another element that has bolstered SCHD's reputation is its low expense ratio. Cost effectiveness is often overlooked by investors, especially in the ETF world. Yet over the long run, an ETF's expense ratio can significantly impact net returns. SCHD's conscious effort to keep this low ensures that more of your money is actually invested rather than being eaten up by fees. However, today's focus will shift a bit. We'll dive into 4 ETFs that, in our opinion, have the potential to outdo SCHD in the upcoming decade. Each of these ETFs brings something unique to the table, whether it's their sector allocation, geographical spread, or underlying investment philosophy. Let's consider the ever-evolving dynamics of the global economy. Emerging markets are presenting unprecedented opportunities. Technological advancements are reshaping industries, and there's an ongoing shift towards a more sustainable future. Given these factors, the investment landscape of the next decade will look quite different from the past. As such, it's imperative for investors to stay adaptable and be ready to pivot their strategies. As we delve into these options, we'll share investment strategies tailored to maximize returns, whether through a 401k or a personal brokerage. It's not just about picking the right assets. It's also about understanding how to efficiently allocate and manage them. As we navigate the complexities of the investment world, it becomes paramount to align our portfolio choices with our long-term goals, risk appetite, and financial aspirations. In the ever-changing landscape of investments, the one constant that remains is the power of informed decision-making. As we introduce these ETFs and strategies, our aim is to empower you with the knowledge to make decisions that will shape your financial future. Remember, it's not about chasing the hottest trend, but about building a portfolio that stands the test of time, delivering consistent returns and ensuring financial peace of mind. Stay with us as we embark on this journey, unraveling the intricacies of these promising ETFs and the strategies that can catapult your investments to new heights. First, let's talk about a potential contender, the Vanguard High Dividend Yield ETF. Recognized by its ticker, BYM, this ETF mirrors the FTSE High Dividend Yield Index. It features high-yield dividend companies from the US, excluding REITs. It's a passive fund, meaning fewer fees, and is diversified with over 440 stocks. Industries like financials, healthcare, and industrials dominate its holdings. With giants like Johnson & Johnson, JP Morgan, and Home Depot in its top 10 list, and an expense ratio of only 0.06%, it's a reliable player in the dividend game. Now, if you've been with Dividend and Conquer for a while and are enjoying this breakdown, don't forget to hit that subscribe button. Your support keeps us going. Next on our radar is JEPI, the JP Morgan Equity Premium Income ETF. Its astounding 12.39% dividend yield has raised eyebrows. While high dividends can be a sign of trouble, JP's underlying strategy offers some reassurance. Essentially, it employs a covered call ETF strategy. They use an ELN structure, allowing them to write covered call options on the S&P 500, thus benefiting from these options. The fund is dominated by stocks from low-volatility companies of the S&P 500. However, potential investors should be cautious. JP, being a relatively new entrant since 2020, doesn't have a decade-long performance record to analyze. On the third spot, we have DGRO, which shadows the U.S. Dividend Growth Index by Morningstar. This fund's unique aspect is its rigorous screening process. They ensure a consistent dividend growth history and focus on companies that are set for future dividend expansion. With a mix of small, medium, and large-cap stocks, its diversified nature is commendable. Though the current dividend yield of 2.27% may seem modest, its long-term growth prospects, with behemoths like Microsoft and Apple in its portfolio, make it an exciting choice. Lastly, we explore an ETF that boasts of a sustainable dividend yield over 5%. This ETF strategically chooses the top 80 companies based on their sustainable dividends. The Proven Dividend Sustainability (PDS) ETF, ticker PDSE. Here's an example. Imagine if you were to grow a garden. Some plants in your garden are like the typical stocks in the S&P 500. They might grow quickly, but sometimes they're prone to wilting if the weather gets rough. Now let's say you had some special plants that not only grow steadily, but also produce delicious fruit each season, irrespective of weather changes. These plants are akin to dividend stocks, particularly those in PDSE. The fruits they bear, those are your dividends, providing you with tangible returns season after season. Just as a wise gardener would nurture these fruit-bearing plants, an astute investor recognizes the long-term value of consistent and sustainable dividends. PDSE focuses on metrics like payout ratio, consistent dividend history, and potential future growth to determine which companies have the capability to maintain and grow their dividends. It's like ensuring that the soil, sunlight, and care provided to the plants are perfect, ensuring bountiful harvests in the form of dividends. Now, with a portfolio predominantly made up of stalwarts in the tech, finance, and healthcare sectors, it boasts of names like Adobe, Goldman Sachs, and Pfizer. And while its expense ratio of 0.25% is higher than some, the quality of its holdings and its yield make it a worthy consideration for any dividend-focused portfolio. Throughout history, wise investors have navigated the unpredictable waters of the financial market with a compass crafted from knowledge, intuition, and strategic thinking. It's easy to get swayed by flashy numbers and trending buzzwords. But remember, like the tree that stands tall through a storm, the beauty of dividend investing lies in its resilience and consistency. The world of dividends is not just about the numbers. It's about the stories these numbers tell. It's about companies that have weathered economic downturns, market volatility, and global events, yet continued to reward their shareholders. It's a testament to their commitment, their vision, and their belief in sustainable growth. As we journey through the world of investments, it's essential to recognize and appreciate the unwavering nature of dividend returns. Even as markets ebb and flow, the right dividend investments can provide a steady stream of income, complementing other growth-focused assets in our portfolio. At Dividend and Conquer, our mission is to empower you with knowledge, to inspire you with insights, and to remind you that in the vast sea of investments, dividends are the lighthouses guiding us safely to our financial goals. With the horizon in sight and the wind at our backs, let's set sail together on this voyage of dividend discovery. And as always, remember to invest wisely, think long-term, and let the dividends do their magic. Before we wrap up, here's something to ponder. If you had $10,000 to invest today solely in dividend ETFs, which one among SCHD, BYM, JEPI, DGRO, and PDSE would you choose? Or would you diversify amongst them? Think about the potential growth, risks involved, and the consistent returns in the form of dividends. Drop your thoughts in the comments below. We're eager to know how our Dividend and Conquer community thinks. Remember, we are not financial advisors, and the content presented in this video is for informational and educational purposes only. Always consult with a licensed financial professional before making any investment decisions. Thank you for tuning in to Dividend and Conquer. If this content added value to your investment journey, do give this video a thumbs up and subscribe for more insightful dividend discussions. Until next time,